Welcome back to Talk Tickers, where we take those earnings calls, rip them apart, and try to figure out what it all means for investors. And today we're going to be looking at Southwest Airlines Q4 2024 earnings call.
So they actually beat expectations for the quarter. They had some really strong revenue growth, showing that they're not just riding a good travel market, but they're actually making some smart strategic decisions.
Yeah, it seemed like they were firing on all cylinders. I mean, they reported that 8% jump in RASM, the revenue per available seat mile compared to a year ago. That's a pretty significant number, right?
Yeah, it is definitely indicates they're doing better than the industry average. What's interesting is how they got there. Seems like they implemented a mix of tactical improvements. They mentioned tweaking their capacity and really fine-tuning those revenue management strategies.
So they're getting more efficient with how they're using those seats and how they're pricing them?
Hmm.
But it wasn't all smooth selling, was it?
No, definitely ran into some turbulence. They're facing some pretty intense cost pressures, which is something a lot of companies are dealing with right now. They saw that their unit costs, specifically CSMX, which strips out fuel and those special items, that went up year over year by over 11%.
Ouch, an 11% jump in cost. What's behind that?
Yeah.
What's driving that increase?
Well, the outgoing CFO, Tammy Romo, she pointed to inflation as the main culprit, especially in those big areas that tend to hit everyone hard. Labor costs, those pesky airport fees, and of course, healthcare expenses.
I feel like inflation is just this giant net, and the airline industry is right in the middle of it,
Yeah, it's coming at them from every angle. They even mentioned that the slowdown in their capacity growth was also contributing to those cost pressures.
So when they're flying fewer seats, naturally the cost per seat is going to go up. Makes sense. But didn't they announce a cost reduction plan to try to combat this?
They did, and it's pretty ambitious, aiming for $500 million in savings. And they're putting a big focus on getting that corporate overhead leaner.
So cutting out some of the bureaucracy and finding ways to be more efficient, that sort of thing.
Yeah, exactly. They're looking at things like holding back on new hires, really optimizing how they schedule everything to get the most bang for their buck, even exploring ways to save money within that whole supply chain.
So multi-pronged attack on this cost problem, huh?
Yeah.
Now, they did say they expect CSMX to continue climbing. I think it was between 7% and 9% year over year in the first quarter of 2025. Still a pretty big jump, isn't it?
Yeah, it is. But they do seem to think it'll start to level off as the year goes on.
So there's hope on the horizon that those costs might start to come under control in the long run.
Yeah, they seem to think so. They're expecting that year-over-year unit cost inflation to ease up. They're kind of banking on a few things to help. Those labor contract anniversaries passing, rolling out their planned capacity growth, and finally starting to reap the benefits of all those cost-cutting measures.
Okay, makes sense. Now let's talk about their fleet strategy. We touched on this in the pre-show notes. They're in a really unique spot right now where they could actually profit off the current market, by selling some of their older aircraft and maybe even dabbling in some sale-leaseback transactions.
Right. And this is where things get interesting. What makes this such a golden opportunity for them at this particular moment?
Well, there are a few key factors at play here.
I'm all ears. Lay it on me.
First off, there's this huge demand for used aircraft right now, largely because of those ongoing supply chain issues and, of course, those pesky Boeing production delays we've all been hearing about.
So basically, it's a seller's market. They have some leverage to get good prices.
Bingo. Secondly, they've got what you might call embedded value in their current fleet, especially those 800 series aircraft. That goes back to the sweet deal they got from Boeing way back when they bought those planes.
So they're holding some valuable assets they could sell for a tidy profit. Precisely. And third, they've got this substantial order book with Boeing, which means they have access to more planes than they actually need right now for their growth plans.
So they could unload some of those older models, bring in those sleek new 737 AGX aircraft, and still have plenty of planes to expand their operations.
It's like a strategic trifecta: generating cash, modernizing their fleet, and setting themselves up for future growth. Talk about a win-win-win.
Now, they did say they prefer to just sell those 800 series outright rather than messing with sale-leasebacks.
Yeah, outright sales give them the cleanest way to replace those aging planes with the new MAX aircraft. More fuel efficient, better reliability, and, a better experience for the passenger.
Plus, it gives them more control over their fleet and cuts out those ongoing leasing costs.
Exactly. But it's worth noting they haven't completely ruled out sale-leasebacks. They see them as a potential tool to manage that transition period, kind of a bridge until they're sure Boeing can deliver those replacement planes on schedule as per their contract.
So they're hedging their bets, keeping their options open. Smart move. What kind of financial impact do they think these fleet transactions will have? Have they given any hard numbers?
They're keeping those cards close to their chest. No concrete guidance yet on the total proceeds they're expecting, but they did emphasize that they're trying to squeeze every last drop of value out of that order book.
Sounds promising for investors, for sure. And they did mention using those proceeds for share buybacks, right?
Yeah, they're planning a pretty hefty buyback program, aiming for a whopping $2.25 billion worth of stock repurchases in 2025. That's like 12% of their current market cap, if you can believe it.
Talk about putting your money where your mouth is. Definitely a sign that they believe in their future.
And they were very clear that these buybacks aren't dependent on how well their fleet monetization strategy goes. They're committed to rewarding those shareholders no matter what happens with Boeing.
That's a big statement. Shows confidence. So they're investing in the business, they're buying back shares, painting a pretty shareholder-friendly picture here.
The outgoing CFO, Tammy Romo, she actually highlighted their commitment to hitting specific financial targets by 2027, before she rides off into the sunset after a whopping 33 years at Southwest.
Let's refresh our memory on those targets. What are they shooting for exactly?
Their main goal is to achieve an after-tax return on invested capital of at least 15%.
Sounds ambitious. Break that down for us regular folks. What does that actually mean?
Basically, they want to get a really good return on all the money they've poured into the business. It's a measure of how effectively they're turning that capital into profits.
Okay, so they're shooting for a high level of profitability. Makes sense. What else is on their target list?
They're also aiming for operating margins, excluding special items, of over 10%.
So the classic formula.
Yeah.
Keep costs low, keep profits high. Makes sense. How do they plan to actually reach those targets?
They're taking a two-pronged approach. First, improving those core business operations, all those things we talked about with the Southwest Even Better plan. And then, of course, executing those strategic financial moves like that fleet monetization strategy.
So a mix of operational excellence and some clever financial maneuvering.
Yeah, exactly. And they made it clear that hitting those 2027 targets is mostly about improving how their core business runs, not just relying on one-time gains from selling off aircraft.
They're not just looking for a quick buck. They're focused on building a business that can thrive for the long haul.
Now, before we move on, there's one more crucial area we should touch on. Capital expenditures, or CapEx, as the finance folks like to call it.
Ah, yes, CapEx. Always sounds a bit intimidating. Can you simplify it for us?
Basically, CapEx is all the money a company spends on those major investments. Things like new planes, shiny new facilities, or those fancy technology upgrades.
So the big ticket items they need to grow and expand.
Exactly. In 2024, Southwest's gross capital expenditures came in at $2.1 billion, right on target with their previous guidance.
That's a lot of dough. Where'd all that money go?
Most of it went towards those aircraft-related expenses, but they also invested in non-aircraft CapEx, probably stuff related to those operational improvements and technology upgrades we discussed earlier.
So they're investing in both the physical stuff like the planes and the less tangible stuff like technology and processes.
Looking ahead to 2025, they're projecting their gross capital spending to be somewhere between $2.5 billion and $3 billion.
Even more than last year. What's driving that increase?
They're planning on spending about $1.2 billion on aircraft CapEx, probably for those new 737 MX planes we talked about, and another $1.6 billion on non-aircraft CapEx, which could include things like upgrading their facilities, investing in technology, and actually implementing those Southwest Even Better initiatives.
So they're putting their money where their mouth is, investing heavily in their future. We talked about share buybacks earlier, but what about dividends? Any plans to shower those shareholders with some cold, hard cash?
Well, in 2024, they returned a total of $680 million to their shareholders, with $430 million going towards dividends and $250 million going towards buybacks.
Not too shabby. That's a pretty nice chunk of change for those investors.
And they said they're planning on doing another $2.25 billion in buybacks in 2025, just to hammer home their confidence in their future.
They're hitting all the right notes, investing in the business, buying back shares, and paying out dividends. It all points to a pretty shareholder-friendly approach.
Throughout this whole call, they kept emphasizing how important it is to them to maintain that strong balance sheet and keep that investment-grade credit rating.
They're not just chasing short-term gains, they're playing the long game, trying to build a company that's both sustainable and financially sound.
You got it. Now, before we wrap up this first part of our deep dive, there's something Bob Jordan, the CEO, said that I thought was really worth mentioning.
I'm listening. What was it?
He stressed that their goal isn't just about hitting those financial targets, it's about fulfilling their purpose as a company.
And what would you say that purpose is?
He put it beautifully. We connect people to what's important in their lives through friendly, reliable, and low-cost air travel.
It's a good reminder that behind all the numbers and all the financial jargon, there's a human side to this industry.
Absolutely. And it's clear that Southwest really is committed to putting those people first in everything they do.
Well said. Now let's take a quick break and come back for part 2 of our Southwest Airlines deep dive, where we'll really get into the nitty-gritty of their financials and analyze the implications of their strategic decisions. Stay tuned.
Welcome back to Talk Tickers. Let's jump right back into our deep dive on Southwest Airlines Q4 2024 earnings call.
Okay, so we talked a lot in part 1 about all those improvements they've made operationally and their big Southwest Even Better plan. But let's switch gears now and really zero in on their financials.
Yeah, one thing that really pops out is how much pressure they're feeling on those unit costs.
Can you break that down for us? What exactly are unit costs and why are they so important in the airline world?
Basically, unit costs are the expenses an airline racks up for every available seat mile, or ASM. It's a key metric to see how efficient and profitable they are.
So the lower the unit cost, the better off they are.
You got it.
Yeah.
And in Southwest's case, their CSMX, that's their unit cost minus fuel and special items, it jumped up 11.1% year over year in Q4.
That's a pretty steep climb. What's causing that increase?
Well, Tammy Romo, the CFO who's on her way out, she pointed the finger at inflation, especially in those big areas. Labor costs, those airport fees that always seem to be going up, and of course, healthcare costs.
It seems like inflation is hitting everyone hard, and the airline industry is right in the crosshairs.
It's coming at them from all sides. They also mentioned that slowing down their capacity growth added to the pressure on those unit costs.
So when they're flying fewer seats, the cost per seat is naturally going to go up. Makes sense. But didn't they say they're going to try to tackle this with a cost reduction plan?
They did, and it's pretty ambitious. They're aiming for $500 million in savings, with a big emphasis on slimming down that corporate overhead.
So cutting the fat, getting rid of some bureaucracy, finding ways to do more with less, that kind of thing.
Exactly. They're looking at things like maybe not hiring as many new people, getting really smart about their scheduling to squeeze out more efficiency, and even seeing where they can save money in that whole supply chain operation.
So a multi-pronged attack on those rising costs. Now, they did project that their CSMX is going to keep going up, something like 7% to 9% year over year in the first quarter of 2025. That's still a pretty significant jump.
It is, but they seem to be thinking that number will start to come down as the year goes on.
So there's some optimism that they can get those costs under control in the long run.
Yeah, they seem to think so. They're hoping that year-over-year unit cost inflation will ease up as they get past some of those labor contract anniversaries, implement their planned capacity growth, and start to see the results of all those cost-cutting measures.
Fingers crossed. Now let's talk about their fleet strategy. Remember how we mentioned in part 1 that they're in this unique position to actually make some money off the current market by selling some of their older planes and maybe even doing some sale-leaseback deals.
Right. This is where things get really interesting. Why is this such a prime opportunity for them right now? Well, there are a few key factors at play here.
Okay, break it down for us.
First off, used aircraft are in super high demand right now, mainly because of those supply chain snags and those Boeing production delays that have been dragging on.
So it's a seller's market. They can basically name their price.
Pretty much. Secondly, they've got a lot of what you might call hidden value in their fleet, especially those 800 series aircraft. That's because of the great deal they got from Boeing when they bought those planes back in the day.
So they're sitting on some assets they could sell for a nice profit.
That's the idea. And third, they've got this huge order book with Boeing, which means they've got more planes coming than they actually need right now to grow their business.
So they could sell off some of those older planes, bring in the shiny new 737 MAX aircraft, and still have plenty of capacity to expand.
It's a triple win. They're generating cash, modernizing their fleet, and setting themselves up for future growth. It's a pretty smart move.
They did mention that they'd rather just sell those 800 series planes outright instead of getting into those sale-leaseback arrangements.
Yeah, selling them outright is the simplest way to swap out those older planes for the new MAX aircraft. You know, the MAXs are more fuel efficient, they're more reliable, and they offer a better experience for the passengers.
Plus, it gives them more control over their fleet, and they don't have to worry about those ongoing leasing costs.
Exactly. But it's worth noting that they haven't completely ruled out sale-leasebacks. They see them as a possible tool to manage that transition, kind of a bridge, until they're absolutely sure Boeing can deliver those replacement planes on time, as per their contract.
So they're keeping their options open, which is always a good idea.
Yeah.
How much of a financial impact do they think these fleet transactions will have? Have they given any specific numbers?
They're being a little coy on that front. They haven't released any concrete guidance on how much they expect to make from these sales, but they did emphasize that they're trying to get the most bang for their buck out of that order book.
Sounds like good news for shareholders.
Oh.
And we talked about share buybacks earlier, right?
They're planning a pretty big buyback program, aiming to repurchase $2.25 billion worth of stock in 2025. That's roughly 12% of their current market cap, which is pretty significant.
That's a pretty clear sign that they're confident in their future.
And they were very adamant that these buybacks aren't tied to how well their fleet monetization strategy goes. They're committed to giving back to those shareholders no matter what happens with Boeing.
It's a bold move, but it shows they're serious about creating value for their investors. So they're investing in the business, they're buying back shares, they're paying dividends. It's a pretty shareholder-friendly picture they're painting.
Tammy Romo, the outgoing CFO, she made a point of highlighting their commitment to hitting those specific financial targets by 2027 before she heads off into retirement after an impressive 33 years with Southwest.
Right, let's go over those targets again. What are they aiming for exactly?
Their primary goal is to achieve an after-tax return on invested capital of at least 15%.
That sounds pretty ambitious. What does that mean in plain English?
Essentially, they want to make sure they're getting a really good return on all the money they've invested in the business. It's a way of measuring how effectively they're turning that capital into profits.
So basically, they want to be very profitable. Makes sense.
Mm-hmm.
What else is on their list of goals?
They're also targeting operating margins, excluding special items, of over 10%.
So the classic formula. Keep costs low, keep profits high. It's a solid strategy. How are they planning to actually achieve these targets?
They're taking a two-pronged approach. First, they're focusing on making their core business operations as strong as possible. All those Southwest Even Better plan initiatives we talked about. And then, of course, they're using strategic financial moves like that fleet monetization strategy.
So it's a combination of operational excellence and smart financial maneuvering.
Exactly. And they were very clear that hitting those 2027 targets is mostly about improving how their core business runs, not just relying on one-time gains from selling off aircraft.
So they're not just looking for a quick win. They're focused on building a business that can thrive in the long run.
Now, we've covered a lot of ground, but there's one more important area we need to touch on.
Yeah.
Capital expenditures.
Right. CapEx. Always sounds a bit technical. Can you break it down for us?
Think of capital expenditures as the money a company spends on those big investments, like new aircraft, facilities, or technology upgrades.
So basically, the big ticket items that are crucial for growth and expansion.
Exactly. In 2024, Southwest's gross capital expenditures came in at $2.1 billion, right in line with what they had projected earlier.
That's a significant amount of money.
Yeah.
What did they spend all that on?
A big chunk went towards aircraft-related expenses, but they also invested in non-aircraft capital spending, probably stuff related to those operational improvements and technology upgrades we talked about earlier.
So they're investing in both their physical assets, like planes, and those less tangible assets, like technology and processes.
Looking ahead to 2025, they're projecting their gross capital spending to be somewhere between $2.5 billion and $3 billion.
That's even more than they spent last year? What's driving that increase?
They're planning to allocate about $1.2 billion to aircraft capital spending, probably for those new 737 MAX planes we've been discussing, and another $1.6 billion to non-aircraft capital spending. That could include things like facility upgrades, technology investments, and putting those Southwest Even Better initiatives into action.
So they're continuing to invest heavily in their future. We talked about share buybacks earlier, but what about dividends? Are they planning on rewarding their shareholders with some cold, hard cash?
Well, in 2024, they gave back a total of $680 million to their shareholders, with $430 million going towards dividends and $250 million towards share repurchases.
That's a pretty generous return for those investors.
And they've already announced that they plan to do another $2.25 billion in buybacks in 2025, which really shows how confident they are in their future prospects.
They're checking all the boxes.
Yeah.
Investing in the business, buying back shares, paying dividends. It's a very shareholder-friendly approach.
Yeah, they kept hammering home the point that maintaining a strong balance sheet and keeping that investment-grade credit rating is super important to them.
It's clear that they're not just focused on short-term gains. They're playing the long game, building a company that's both sustainable and financially sound.
You got it. Now, before we wrap up part 2, I want to highlight something Bob Jordan, the CEO, said in his closing remarks.
Okay, what was it?
He stressed that their ultimate goal is bigger than just hitting those financial targets. It's about fulfilling their purpose as a company.
And what would you say that purpose is?
He put it beautifully. We connect people to what's important in their lives through friendly, reliable, and low-cost air travel.
It's a good reminder that behind all the numbers and financial jargon, there's a human side to this industry.
Absolutely. And it's clear that Southwest is dedicated to putting those people first in everything they do.
Well said. Now let's take a moment to gather our thoughts and get ready for the final leg of our Southwest Airlines deep dive. We'll wrap things up with some key takeaways and, of course, our signature "This is not financial advice" segment, where we'll cook up a bold trade idea inspired by today's conversation. Stay tuned. And we are back for the final leg of our deep dive into Southwest Airlines Q4 2024 earnings call.
We've been through a lot, haven't we? Analyzed their impressive performance in Q4, dug into that ambitious Southwest Even Better plan, even kicked around that intriguing fleet monetization strategy.
Yeah, we've covered a lot of ground, from their operational wins to those cost challenges and those ambitious financial goals they've set for themselves.
So let's bring this plane in for a nice smooth landing and see if we can pull out some key takeaways for our listeners.
Sounds like a plan? First, let's take a step back and look at the big picture. What's your overall assessment of where Southwest stands right now?
I think it's safe to say they're in a pretty strong position. Beating those Q4 expectations shows they're able to adapt and thrive in this crazy economic climate, and their focus on operational excellence, that's really paid off. Look at that second place ranking in the Wall Street Journal's airline rankings. That's impressive.
They've really gone beyond just being that friendly, low-fare airline. They're a real powerhouse when it comes to efficiency.
You said it. And they're not letting up on making things better for their customers. All those initiatives like assigned seating, premium seating, and that new Getaways by Southwest thing, it shows they're willing to change and adapt to what travelers want.
They're not content with just sitting back and relaxing. They're always looking for ways to innovate and improve the flying experience.
But it's not all sunshine and rainbows. Of course, those rising unit costs, mainly because of inflation and those labor expenses, that's a major hurdle they're facing.
Yeah, that cost issue is something we definitely need to keep an eye on. But it seems like they're taking it seriously with that aggressive cost reduction plan, aiming for $500 million in savings.
They're really focused on streamlining their operations and finding ways to offset those rising costs. And that fleet monetization strategy, it's bold, but it could bring in a ton of cash, fuel their growth, and maybe even create a lot of value for shareholders.
It's a calculated gamble, but if it works out, it can be huge for Southwest. Speaking of bold moves, let's move on to our favorite segment. This is not financial advice. Got any outrageous yet plausible trade ideas for us today?
Remember that hypothetical scenario we talked about where Southwest goes all in on their fleet monetization strategy and sells off a bunch of their aircraft?
You mean the one where they turn their fleet into a giant piggy bank?
That's the one.
Yeah.
Now let's take it a step further. What if instead of just using all that cash for buybacks, they actually go out and make a strategic acquisition?
Whoa, an acquisition. Now that's interesting. Who would they even be looking at?
Well, there's been a lot of talk about consolidation in the airline industry lately. What if Southwest sets their sights on a smaller, struggling carrier, like, say, Frontier Airlines?
That would definitely shake things up, Southwest. With their great customer service and operational efficiency, merging with Frontier, known for their ultra-low fares and, well, let's just say their unique brand personality.
It would certainly make some headlines. And think about it. Southwest could use their expertise to help Frontier improve their operations and customer satisfaction, while also getting access to new markets and a younger, more budget-conscious customer base.
It's definitely a risky move, but it could create a real powerhouse in the low-cost airline space, maybe even rivaling Spirit or Allegiant.
Exactly. And of course, we have to say it again, this is all purely hypothetical. This is not financial advice. It's just a fun thought experiment to think about as we watch how things unfold for Southwest.
Absolutely. Well, there you have it, folks. We've reached the end of our Southwest Airlines deep dive. We've analyzed their financials, dissected their strategic plans, and even ventured into the world of hypothetical trading.
We hope this deep dive has given you some valuable insights and maybe even sparked some questions of your own as you follow Southwest's journey.
The airline industry is constantly changing, and what we've talked about today is just a snapshot in time. But by staying informed and keeping an eye on the trends, we can all gain a better understanding of this fascinating sector.
Until next time, stay curious and keep your eyes on the skies.
And as always, fly safe and invest wisely. Thanks for tuning in to Talk Tickers.